Hi, Steve Van Metre here, and welcome to your weekly economic update, where we take about 30 minutes every Friday to take a deeper dive into the markets and, well, see if they make any sense. I'm not sure that they do. Some of our topics today are, yes, interest rates can go negative, and we're going to talk about why interest rates falling haven't made a difference. So even though President Trump wants the federal funds rate down, it's not going to make any difference. And then we got to get into what's about to come next month. The content of this video is provided as educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre Personal Capacity. Opinions expressed in the video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial. Now, there's a lot of talk lately about things like modern monetary theory, which I'm not interested in overly discussing at the moment, and how the United States cannot have negative interest rates. Okay, let's put that aside. Yes, we can. Will it be good? No, it won't. So people, when I hear people say, the United States can have negative interest rates, I think it's out of a fear of, if we did, the monetary system is going to break. Yeah, I totally would agree with that. But the notion that we can't have negative interest rates, I mean, right now, when we get into the you'll see we have still one of the largest or the largest short position against 30-year long-term bonds in history. We're 18 months deep in the Fed. We've got an 18-month lag on monetary policy that's getting deeper by the month, deeper in terms of how much it hurts the economy. You've got trillions of dollars sitting in equity funds that have the capability of shifting into bonds. Trillions of dollars. You've got large corporate banks buying. You've got the Fed cutting. You've got foreign investors buying. So yeah, interest rates can go negative, and I expect them to. And along those lines, we have seen interest rates come down in the last, over the last, say, 11 months. We're now, as of next week, we'll have an 11-month lead. 10-year Treasury yields will have an 11-month lead peaking before the stock market. The record is 14 months. So we know this thing just can't keep going much longer. I mean, it just can't. And most likely in the next few months, unless we set a record, which we could, it will break. But I want to, in fact, that's actually a pretty good reason why to think, something like, well, look at all the data and think, oh yeah, we're going to hit 11 months. The longest is 14. And that's going to happen next 90 days, and a lot of interesting things happen in the next 90 days. We get a Fed meeting in the middle of next month expected to cut. My expectations are they're cut. We'll try to look at that data next week, even though Labor Day holiday, we won't have a video on Monday. You have the corporate share buyback blacking out. Now, that doesn't really matter in terms of interest rates. It matters in terms of if stock prices start to go down and volatility starts to rise. You get a shift from the stock procs that can dynamically, over days, weeks, and months, shift into bonds. So that is a factor as well. And there was, the big Treasury binge borrowing, the $300 billion plus the whatever above and beyond that. It's due to the new budget. Wow, it's going to be interesting. All the markers are there to say that this thing is almost at its end. So let's go ahead and look at some charts. And maybe I'll remember whatever the third thing I was going to talk about. It's Friday. It's holiday weekend. Memory's not that great at the moment. M2 money supply growth rate slowed to 5.26% on an annualized basis. The 6-month, 3-month rate of change now have reversed direction. The 3-month rate of change took the biggest slide, as I expected. Now, since we're back in the mode where the Treasury is not draining their coffers down, we got to see the economy now running on its own. This should continue to fall, and this is once it breaks zero, it's really bad news for the money supply and the broad economy. Commercial industrial lending, not much change over last week. Growth rate, was that up or down? I think it's down, but slightly. But it could stay up. It doesn't matter. The change is almost negligible from last week. It's almost as if people who are borrowing money are just sidelined at the moment, not sure if they should take on more debt or if they should pay off their other debt. They're just kind of holding steady. But consumers are slowing down their spending. The growth rate of the credit cards is down to 4.2%, and following this longer trend down. This is not a good sign for the healthy economy, and it's also another reason the Fed may be forced to cut. Oh, you know what? That is not what should happen. There should be another slide, and I thought I unhit it, but maybe I hit it. Let's see if we can get it back. Now, before we look at that, I want to hit up the NASI, and I want to talk about what we haven't been able to because the Hedgeopia website's been down. It's back. I think it was up. It was just running extremely slow. But anyways, look at the NASDAQ McClellan Summation Index. Market is just dying for liquidity. It's thirsty. It needs money. It needs liquidity. It's trying to push higher in price, but in terms of liquidity, it is just absolutely struggling. Now, let's go look at Hedgeopia. I want to come back to that PowerPoint slide. In fact, let me get it loaded up. There we go. So here we can see hedge fund positioning on the 10-year Treasury. I mentioned on Monday and Wednesday that I was super excited to see this on Saturday, and I will be super excited to see it this Saturday as well. This shows that rather than backing out of their short position, that speculators are holding or adding on to their short position. So in 10-year Treasury note, they held, which is awesome because yields do not bottom historically until speculators are long. Looking at the 30-year Treasury bond, this is 30-year yields in red, and we could see very long positioning here. And you say, well, it's not as long as it was. Okay, that's the part I want to address at this moment in time. The chart at Hedgeopia does not show all short positions. It just shows the speculators, which are generally hedge fund managers. Here is from zerohedge.com the total short positions of everybody who is short 30-year ultra long bonds. And you can see they are near their record short position. So those who don't think yields can go lower, this is a short interest on 30-year bonds. When this gets unwound, it's going to take interest rates significantly lower. And that is part of the reason why I have been very optimistic about interest rates going to zero and being a part of that drop so we can make some money on bonds, a lot of money actually. Oil, no surprise, with starting to show some signs of draws. Speculators are back long oil, hoping that Russia, Saudi Arabia, OPEC, and anyone that has oil cuts its production. Of course, if you cut production, you're going to cut jobs. Doesn't make sense. S&P 500, we see hedge funds took some risk here. It paid off. Market when we did go back up a little bit. As far as gold, they are now at officially the our longest record position in gold. This will unwind. That will find the floor of whatever this long 5-year pattern that's not entirely shown here. That would be a place to go. And if it's wrong, we'll just buy emerging markets because they've been signaling that gold is out of line. Speculators are still long the NASDAQ. Not surprised considering that most of the companies buying their shares back are tech companies. And they remain very short the Russell 2000 and the dollar, which is showing signs of breaking higher, which would be very bad news for the U.S. economy since the rising dollar is a function of a tightening. It has a tightening effect on the economy. So they're still long the dollar, and they backed off of some of their volatility shorts. But I'm going to guess when we look at this Wednesday, we'll see that they're pushing their volatility shorts back down, which is where we want to see them do to be mispositioned. So looking at the weather update, the Midwest is going to get this big cold front. Now, why are they getting this? Because there is a hurricane, class 4, rolling through here. And back in the 70s, this happened where it kind of shot across and hung out here in the Gulf of Mexico. And it attracts this warmer weather, which pulls cold weather down from Canada and the North Pole. So we're seeing some of that effect here. As far as rain, really the hurricane is actually helping because it's pulling some of that weather down. So there's not a lot of rain expected in the Midwest region where you're seeing below average precipitation, which farmers will be happy about. They're not going to be happy about this cooler weather. Over the 8 to 10 day forecast, they got a lot of cooler weather, some heat in the lower region, which farmers way down here will be happy about, but up here, not so much. And looks like that rain that's building up here is pushing east. So again, not ideal situation for what the farmers are hoping for, at least to get their crops back out. So looking at Treasury and agency securities, up $13 billion for the week. Where did that come from? Mortgage-backed securities, they added just $2 billion. $1 billion of U.S. Treasury bonds. And under other securities, they sold off, assuming these are not government insured, $1 billion of mortgage-backed bonds, and added $7 billion or almost $7.5 billion of other non-mortgage-backed securities that are not Treasury securities. So again, banks continue to buy bonds that added, like I said, $13 billion. They're keeping interest rates from taking off, which is pretty cool. So let's take a look at the charts. I don't know that I have. Let me see if there's Twitter just refreshed. And sometimes people post some interesting stuff right after market hours, but I don't see anything. So let's head on to the S&P 500. It gapped over the resistance it found yesterday, hit the big resistance level that we can now look back to September 2018, right in there. And it's been tagging up against this resistance level a lot and getting nowhere. So heavy selling here, 50-day moving average. The market needs to jump over this if it can. That's what the market wants. If it's got a shot at trying to get back to all-time highs, it's got to bridge this gap, and it's struggling. Now, part of the reason it's struggling is because of Apple. And Apple, as we've looked at, has this big symmetrical triangle, but in the midst of that symmetrical triangle is also a right triangle forming. And this right triangle is got selling all between 210 and above, but mostly between 210 and 215. If Apple's got sellers sitting here that have got a lot of shares to sell, then the stock market's going to be contained. It'll need somebody else to take over the leadership, because whoever's selling Apple has been selling a lot of it and consistently selling it, and they're doing it right in this zone. So if Apple doesn't get through here, the rest of the market isn't going with it. Let's go back and take a look at the NASDAQ. See, it's sitting in a similar range-bound pattern. Again, bulls need to get this over that 50-day moving average, get this thing going. The Dow is looking at a 1, 2, 3, 4, 5 top. Very unusual that you see this long of a consolidation pattern, but it is deemed, well, it's going to be bearish, although everyone wants it to be bullish. It's going to be bearish. Not good. So it's kind of telling us that volatility is going to break out. So if we look at volatility, we see it hit its 200-day moving average. When it makes successive checks against its 200-day moving average, at some point it shoots higher. Looking at the VIX ETF, which you should never buy nor sell, short, long, buy options on, derivatives of, or anything you can think of that would involve you owning this in a direct or indirect method. And you can see that volatility came down into its buy. This is at the moment a buy zone where buyers are buying volatility. It popped up, got rejected. I'm still not going to put it past the short sellers to try to short this down to get stocks back over this heavy level of resistance. And I'm not discounting that, but you can see the fatigue in the market. And the way you see fatigue is, remember when it just used to effortlessly, now it's just struggling. Liquidity is dry. It's very, very dry. How do you know? Well, if you have nothing else to look at, you can also use emerging markets. And emerging markets are a good proxy for U.S. liquidity and the direction of the stock market. And you can see there's a big gap here on the 2-year chart. On the 1-year chart, there's a gap. And so when emerging markets aren't following the broad U.S. equity market higher or leading it, which is what they normally do, it tells you that it's a big struggle. In fact, look at how consistent these chart patterns are. The only difference is you didn't get a big sell-off of the S&P 500. So you can see emerging markets is telling us what's going on. Now, along with emerging markets telling us some things, it also tells us what's likely to happen with gold. We'll come back to that. So gold looks like it's trying to make a top with this, which has the largest long position now in history. It's not getting this breakout. So we know this thing isn't going to the moon on this move. But the next move is what we expect to see gold back off somewhere down into probably, experts are saying 1350s. Yes, there is a lot of support here. Reality is it may get even a little bit lower than that. But somewhere in here, we get a flushing of all these speculators. You find out who the real buyers are, and that's where you take your position. Now, if you miss it, it's okay. You can always buy emerging markets, especially when they're divergent. So if we go under here and put in the gold ETF, you see, okay, gold's up here. So either emerging markets is wrong and needs to rise, or gold is wrong and it needs to come back down. From an emerging markets perspective, what we were looking for, let's go out to the 20-year weekly chart. Let's get gold. You can see here's a chart of gold and emerging markets. You can see they follow each other pretty well. What we're looking for is, does emerging markets find support in this buy zone, or does it break through and signal a major market sell-off? That is the question. And you can kind of see, this is back in 08. It didn't take, let's see, where did it break? In September. So this line here is also telling us when this breaks, there's your volatility surge, there's your interest rate plunge, and your big market sell-off. So this is acting as a huge level of support. It will only be a matter of time before it too is tested. And for that reason, we can look and suggest that likely the gold mining stocks are going to come back down, the silver mining stocks are going to come back down, all the stuff's going to come back down and be a buy signal at a later date, after the bond market makes its move. Why is that? Because here's 20-year treasury bonds. This is in the portfolio, in the legacy portfolios, in Portfolio Shield as a hedge. And what we see here is this line, this dotted orange line, is the former all-time high. And you can see every time it's come back down, it hasn't moved through it. And right up here is 2% on 10-year treasury or 30-year treasury yields, or the equivalent of 2%. This thing is not selling off. Tells us we need to get in this soon. 50-day moving average is rising. That's positive. Looking at the zero coupons, again, 50-day moving average is rising. It's just holding. The banks and the Fed are keeping this thing in check. Even though the Fed doesn't want lower yields, they're doing a good job of keeping yields in check. Let's take a look at crude oil. Oddly, I thought this was kind of odd today. It just totally rejected and erased the last 2 days worth of gains, is now down here on the lower end of this symmetrical 1-year triangle. Again, this thing keeps breaking down below here, and you've got a big sell-off in oil coming. It is validated in the oil and gas producing stocks. Where are they? There they are. And sitting right near their all-time lows, and not looking very pretty. We're not seeing anything of a bottoming pattern here. We're not seeing a big flush of selling, a big shoot of volume. We're not seeing any indication there's any buying opportunity here. And speaking of volume, look at the S&P 500. It's just not generating a lot of thrust here. It's got buyers from the corporates buying their own shares back, but doesn't have a lot of thrust to drive this higher. So maybe in overnight markets when liquidity's thin, the computer algorithms will come in and trade that and try to do it again. I don't know. Looking at bank stocks, you can see these are on the edge of their big zone of support, trying to push higher. A break of this suggests that interest rates are also going with it, and you've got downward trending moving averages and downward trending price. Not too optimistic for the bank stocks, which is great if you own U.S. Treasury bonds. And let's see, last but not least, the ags trying their mightiest down here. And what's nice is even though prices are starting to consolidate here, the sellers are really not able to drive new lows. So this is a good sign. Perhaps this finally will turn around as harvest season gets a little bit closer. All right, what else do I have for you? Let me just kind of scan through here. Lumber prices are trying to show signs of inflation, but downward trending moving average, not a big bottom that you're used to seeing. If you want to see, we can go back to 2000. Was this around in 2008? It was. You can see this big spiraling and then take off. So nothing here going on in lumber that says other than it's trying to consolidate and rally higher. But no indication, that it's saying that inflation is here. And it's still, as we've looked at before, a good proxy for the broad equity market. And it says the S&P 500, needs to be a lot lower, or lumber prices and inflation need to be a lot higher. So let's just wrap things up here. Markets will be closed on Monday, and we'll be back Tuesday. Hope you have a great Labor Day weekend. I'm Steven Van Metre. Bye now.